Okay guys, so before we have a look at our next video, how we make money from exchange rates, what I really want to touch on is just understanding how you always get the value of your pound when you're exchanging them into dollars, or how you get the value of how many dollars you will get in exchange when you buy the base currency, for an example. So remember, we have the base currency and the quote currency. So what I want to do is give you an example just so you can always understand this whenever you're trading the markets or you're exchanging money, because it's really important to know that when you're selling the base currency to buy the quote currency, then you're always going to be timesing the amount of base currency into the quote currency. But in reverse, when you're selling the quote currency into the base currency, you're dividing the amount of the quote currency into the base currency. So here's a prime example. If the pound dollar exchange rate is $1.51, then if we had £1,000 and we was selling our pounds to buy dollars, we would do 1,000 times $1.51, and that equals $1,510 we get in exchange for 1,000 Great British pounds. Okay? On the flip side, let's say you had $500 and you wanted to know how much British pounds do I get for my $500. Well, its exchange rate again was $1.51 for the Great British pound against the US dollar. Then you would basically divide 500 by $1.51, and then that would give you the answer of you receiving £331.12 in exchange. So just remember, whenever you're looking at a currency pair, if you're buying the quote currency because you're selling the base currency, then you're always going to times the base currency by the exchange rate price. On the flip side, when you're buying the base currency and you're selling the quote currency, then you're always going to divide the amount of quote currency you have by the exchange rate to know how much of the base currency you're purchasing. So, have that make sense, guys? And this will make sense when we look at the next video and going through the rest of the course. Thank you. Hello traders, and welcome to this video analysis looking at making money from price changes in exchange rates. So just going to run over how an exchange rate is calculated, how then investors will look to take bets in the market for an exchange rate price to change, and then why they come out of that trade once the exchange rate price starts to go against them, or they perceive the exchange rate price to go against them in terms of one currency starting to appreciate in value against another currency. So traders, an exchange rate is expressing the value of the quote currency for each unit of the base currency. So of course, if you've taken the beginner's course, you have a thorough understanding of how this works automatically. But an exchange rate is simply telling you how much of the currency on the left-hand side do you get in exchange for the New Zealand dollar. So if I have one Aussie dollar, that buys one New Zealand dollar and 10 cents in exchange if the exchange rate of this currency pair is 110, for an example. In reverse, it's simply saying if you had $1.10 New Zealand dollars and you sold it in exchange to buy Aussie dollars, you'd get one Aussie dollar in exchange. So exchange rate is simply telling you one Australian dollar buys $1.10 New Zealand dollars in exchange. Or if you reverse it, on the flip side, it's telling you that $1.10 on New Zealand dollars will buy you one Aussie dollar in exchange. So whenever you're calculating the base currency, you're simply timesing one unit of the base currency by the exchange rate to find out how many of the quote currency you were going to get in exchange. And in reverse, you simply just divide the amount of the quote currency you want by the exchange rate to find out how much you get of the base currency in return. So I'll give you an example just to make it more easy to understand. So if you had $300, so 300 Australian dollars will buy 330 New Zealand dollars in exchange when you times 300 by 1.10, which is exchange rate. Of course, we understand in life, in the real economy, we can only round off money to 2 decimal places. So of course 110, so 300 times 110 equals 330 New Zealand dollars you'll get in exchange for your 300 Australian dollars if you exchange it at this exchange rate price. So that's very simple to understand. And on the flip side, if you had 330 New Zealand dollars, you'd simply just divide it by the exchange rate of 110, and that would tell you how much Australian dollars you would get in exchange. That's really easy to understand. So what we need to understand, traders, is that when we have an exchange rate price that is going to be going up in value for one currency, of course, traders in the market are going to want to invest into the currency as going up in value. Okay, so if your analysis told you that the New Zealand dollar, so the quote currency, was going to appreciate against the Australian dollar in the exchange rate from, for an example, one Australian dollar buys $1.10 in exchange of New Zealand dollars, if then after a while it was going to go to one Australian dollar now buys one New Zealand dollar and 3 cents. So of course you can see you're getting less New Zealand dollars in exchange for each unit of the base currency you're exchanging in exchange rate. So if one Australian dollar was buying one New Zealand dollar and 10 cents, but now one Australian dollar is only buying $1 and 3 New Zealand dollars in exchange, then of course your Australian dollars are buying less New Zealand dollars in exchange, and this is being driven by the appreciation in the quote currency being the New Zealand dollar. So if you knew that was going to happen, what you would want to do, traders, is you'd want to quickly buy the New Zealand dollar at the current exchange rate, wait for the New Zealand dollar's appreciation to go up in value, and then you want to sell your New Zealand dollars back into Australian dollars, and you'll be left over with more Australian dollars than you did in the beginning. So I'll run this over with you, traders. If, for an example, we are investing 100,000 Australian dollars, so we look at this exchange rate and we think, okay, so as an international investor, you may say, I have a feeling or I have a predisposition based on fundamentals, based on interest rate expectations, for an example, the New Zealand dollar is going to go from 110 to 103. So the New Zealand dollar is going to go up in value. Let's say I have 100,000 to invest in this currency to profit from this capital appreciation. If I was to just take my 100,000 dollars, so I own 100,000 Australian dollars. I sell my 100,000 Australian dollars in exchange to buy New Zealand dollars. Of course, with the exchange rate at 110, I then buy 110,000 New Zealand dollars in exchange. Okay. And now, if exchange rate goes to 103, we're going to make a profit, because when you sell your 110,000 New Zealand dollars back in exchange into Australian dollars, you're going to be left over with more Australian dollars than when you started off with it, because 110,000 divided by 1.03 leaves you with 106,796 and 11 cents in return. So if you do this calculation yourself in your phone, do 110,000. So remember, we first had 100,000 Australian dollars. We sold in exchange to buy New Zealand dollars. The exchange rate went up in value in terms of the New Zealand dollars favor. And then when we sold our 110,000 New Zealand dollars that we bought when we first exchanged it from Aussie dollars to New Zealand dollars, and we sell our New Zealand dollars back in exchange to Australian dollars, we're going to be left with 106,000 Australian dollars compared to our original investment, which is only 100,000. So we're now making a profit of 6,796 and 11 cents. So that's clearly showing you how this exchange rate price is going to make you money if you're betting or you're investing in the currency, which is going to be going up in value. And I'll give you a prime example of this happening in the markets recently. So the New Zealand dollar had been gaining strength against the Australian dollar. So we had it around 110 in the exchange rate. The New Zealand dollar then, over the space of a few months, went up in value down to 103 in the exchange rate. And then what happened was, so remember, investors had bought the New Zealand dollar at this price. They made all this profit on the way down as the New Zealand dollars appreciated in value. Once we got to this lower level, something happened when there was really economic data started to come out really poorly for New Zealand, and New Zealand central bank turned around and signaled that they were intending to cut interest rates. They said if the economic data that's been happening continues to play out in the format which it has been, they are going to be willing to cut interest rates to help support the economy, help growth, help inflation, of course, because as people's mortgage payments go down, credit cards, car loans, people have more money to spend, they can spend more money in the economy, and that will help to generate growth, generate inflation. As we know from the interest rate section of the mini course of which I've shown you, interest rates really are the key driver that's going to be driving our currency's value and exchange rates. So soon as markets realized that the New Zealand central bank was pointing towards cutting interest rates, we must remember, traders, that all the investors who were buying at the higher exchange rate price and was now in the big profit from this downtrend, they realize now that the New Zealand dollar is now going to weaken in exchange rate. So they want to close their position in the market and cash in at the best exchange rate price, which is 103. So remember, if you're exchanging your 110,000 New Zealand dollars back into Aussie dollars at the exchange rate of 1.03, remember you're getting 106,796 and 11 cents in return. But traders, just remember, if the exchange rate was to then go up to 107 and investors was to try to cash in at this exchange rate price, they're going to make less money from their trades. So 110,000 using dollars exchange divided by the exchange rates of 1.07, they're only going to make 102,000. They're only going to get back in exchange 102,803,738. You can do the mathematics for yourself. You just simply divide the 110,000 New Zealand dollars by the current exchange rate, and you'll see how much profit you would make. So automatically, traders, we can clearly see that when there's a trend in the market, as soon as investors get the anticipation that the trend may reverse because of monetary policy being implemented by the central bank, such as cutting interest rates, we know that they're going to quickly cash in on this trade because they know at this exchange rate price, this is probably the best price they're going to get for this exchange rate. It's not going to go any lower. And then they're selling their New Zealand dollars back into Australian dollars so they can have more Aussie dollars than when they first started off with at the best price to make the most profit. And this flow of money going from the New Zealand dollar back into the Australian dollar is now causing the Australian dollar to rise in value. When investors were trying to cash in on the New Zealand dollar going up in value, remember, investors were having to buy the Australian dollar, sell it in exchange to invest into the New Zealand dollar, and this flow of money going from Aussie dollars into New Zealand dollars in this exchange rate was causing prices to fall. And then as soon as investors realized this trend was going to reverse, the reversal happened. New Zealand dollars were then being sold in exchange to buy Aussie dollars to get out of the trade, and this flow of money going into the Aussie dollar causes price to rise in the exchange rate. So I hope that makes sense, traders. So you now understand how when you're buying one currency against another currency, you can understand how you can work out how much you're going to be getting in exchange. If an exchange rate price goes in the favor of the currency you're invested in, of course, you're going to make profits. And then once you feel the trend is going to reverse or is looking like it's going to reverse, and it's usually down to monetary policy being set by a central bank, you understand why the flow of money can sharply reverse in the markets, because the investors are wanting to get out of the market at the best exchange rate price so they can make the most profit in their trading account. So I hope that makes sense. Thank you for watching. That's my video on making money